What if you invested $100 a week for 10 years? Most people wonder what their financial future could look like if they just stuck to a plan. Money grows quietly in the background when you consistently invest, even small amounts. The question is, what happens if you invested just $100 a week for 10 years? That's not a fortune. In fact, $100 a week might sound like pocket change compared to big investors who put in thousands at a time. But the magic of consistent investing, compounding interest, and the passage of time can turn those small weekly deposits into something impressive. Let's break it down step by step. Step 1. How much money are you actually contributing? If you invest $100 every single week, $100 times 52 weeks equals $5,200 a year. Over 10 years equals $52,000 total contributions. This is the baseline. You're not magically making $100,000 plus without putting anything in. Your real input is $52,000 over a decade. Now the question is, how does that money grow depending on where you put it? Step 2. Different investment scenarios. To understand the possibilities, let's explore 4 common places where people might invest their money. 1. High Yield Savings Account, HYSA, safe, low return. 2. Stock Market Index Fund, average returns, diversified. 3. Aggressive growth stocks, higher risk, higher potential. 4. Cryptocurrency like Bitcoin or Ethereum, speculative, high volatility. Scenario 1. High Yield Savings Account. Right now, a high-yield savings account might offer around 4% APY, annual percentage yield. Let's assume that's consistent for 10 years. With $100 per week at 4% annual compound growth, after 10 years, your balance would be approximately $63,000. Profit above contributions, approximately $11,000. Not bad, but you're basically just keeping up with inflation. The real power of investing shows up in riskier assets. Scenario 2. Stock Market Index Fund. The U.S. stock market historically returns about 7 to 10% per year after inflation. Let's assume 8% annual return, compounded weekly, with $100 per week. After 10 years, your balance would be approximately $78,000 profit above contributions, approximately $26,000. This is where compounding flexes its muscles. Every year, your returns generate more returns, and your account snowballs faster. Scenario 3. Aggressive growth stocks. What if you handpicked stocks like Tesla, Nvidia, or Amazon during their high-growth phases? Returns vary wildly, but let's assume a 12% annual return, which is above the average index fund. With $100 per week. After 10 years, your balance would be approximately $90,000. Profit above contributions, approximately $38,000. Of course, this comes with higher risk. Growth stocks can crash 50% in a year, so you need a strong stomach to stick with them. Scenario 4. Cryptocurrency, high risk, high reward. Crypto is notoriously volatile. Bitcoin has had an average annual return north of 100% in its early years, but it also crashes 70 to 80% at times. Let's be modest and assume a 15% annual return over 10 years, with $100 per week. After 10 years, your balance could be approximately $110,000. Profit above contributions, approximately $58,000. This scenario sounds exciting, but remember, crypto is unpredictable. You might double your money or lose half of it. Step 3. Why compounding makes a difference. The reason these numbers look so different comes down to compound interest. The principle of earning returns not just on your initial investment, but on your returns as well. Here's a simple breakdown. In year 1, you invest $5,200. It grows a little. In year 2, you invest another $5,200. Now both year 1 and year 2 money are growing. By year 10, you've got 10 years' worth of deposits plus the accumulated returns working together. This is why starting early is such a big deal. Imagine if you kept going 20 years instead of 10. At 8% returns, your balance would balloon to approximately $256,000. That's 5 times your contributions. Step 4. Real-life examples. Let's put this into perspective with real people. The saver. Anna keeps her $100 a week in a savings account. After 10 years, she has approximately $63,000. Safe, but not life-changing. The investor. Mark puts $100 a week in an S&P 500 index fund. After 10 years, he has approximately $78,000, enough to cover a down payment on a house or start a business. The risk taker. Jordan invests in a mix of growth stocks and crypto. Some years are rough, but after 10 years, he has over $100,000. He's taking risks, but the upside is bigger. The moral? Different risk tolerances lead to different results, but consistent investing always beats doing nothing. Step 5. The psychology of $100 a week. It doesn't sound like much. $100 a week is about $14 a day, less than the cost of 2 restaurant dinners, equivalent to skipping coffee shop lattes for a week. But the discipline of consistently setting aside $100, rain or shine, bull or bear market, is what creates results. You're training your brain to think long-term instead of chasing short-term pleasures. Step 6. What about inflation? Inflation eats away at money's value. Over 10 years, the purchasing power of $63,000 in a savings account might be closer to $50,000 in today's terms. That's why investing in assets like stocks, real estate, or even crypto is so powerful. They historically outpace inflation, keeping your wealth growing in real terms. Step 7. Beyond 10 years. The bigger picture. 10 years is a great start, but let's imagine if you kept this habit going longer. 20 years at 8% return, approximately $256,000, 30 years at 8% return, approximately $676,000, 40 years at 8% return, approximately $1.7 million. That's millionaire territory from simply setting aside $100 a week. No lottery tickets, no get rich quick, just consistent investing. Step 8. Practical ways to invest $100 a week. Here are some easy ways to actually put this into practice. 1. Brokerage accounts. Fidelity, Vanguard, Schwab, great for index funds and ETFs. 2. Robo-advisors. Wealthfront, Betterment, automated, beginner-friendly. 3. Micro-investing apps. Acorns, Stash. Let you start small and build consistency. 4. Crypto exchanges. Coinbase, Kraken, Binance, if you're willing to dabble in high-risk assets. 5. 401k or IRA contributions. If your employer offers a match, this is free money. Set up an automatic transfer so you don't have to think about it. Make the habit invisible and painless. Step 9. Common mistakes to avoid. 1. Stopping during market downturns. The best returns often come after crashes. Stay consistent. 2. Chasing hype investments. Don't put all $100 into meme coins or penny stocks. Balance risk. 3. Ignoring fees. High fees eat into returns. Stick with low-cost index funds when possible. 4. Not reinvesting dividends. Let dividends compound for maximum growth. Step 10. Final thoughts. Investing $100 a week for 10 years won't make you an overnight millionaire, but it will build a strong financial foundation. Here's the recap. You contribute $52,000 total. Depending on where you invest, you end up with $63,000 to $110,000 plus in 10 years. Over longer horizons, 20 to 40 years, you're looking at hundreds of thousands to millions. The key takeaway is simple. It's not about timing the market. It's about time in the market. Consistency wins. So if you've been waiting for the perfect time to start investing, this is it. 10 years from now, you'll thank yourself for starting today. Your turn. Would you invest $100 a week for 10 years? Or would you try something riskier like crypto? Drop your thoughts below. If you found this helpful, like this video, subscribe for more financial breakdowns, and leave a comment about what you'd like me to cover next.